Something is building beneath the surface of the silver market right now, and most people can't see it because they're staring at price. They're refreshing charts, debating targets, arguing about whether the next move is up or down. But the real shift isn't happening on a screen. It's happening across counters. It's happening in tone. It's happening in the way buyers are quietly changing what they're willing to hold. Because the loudest development at this moment isn't about spot price, it's about pressure. Pressure in global headlines, pressure inside local coin shops, pressure in the body language of people who suddenly don't want to wait anymore. And if you're watching closely, you can feel that tension long before it shows up as a breakout candle. Now let's ground this. Today in New York, it's Thursday, February 19th, and what's unfolding is less about speculation and more about behavior. The real signal is coming from retail. In one shop conversation, the moment that stood out wasn't dramatic geopolitical commentary. It was something much simpler. Someone looked into the display case and asked, almost casually, "Where did all the small silver go?" That question matters more than any forecast. Small silver doesn't disappear randomly. It disappears when hesitation feels risky. It disappears when buyers believe waiting could cost them. And what makes this interesting is that we're not talking about rare collector coins. We're not talking about limited edition hype pieces. We're talking about old, basic constitutional silver, the kind that used to sit quietly in trays, the kind that felt boring. Suddenly, it's not boring anymore. Constitutional dimes and quarters that once gathered dust are moving quickly, not because they're fashionable, because they're practical. Inside that shop, a key argument gets laid out. If your goal is to maximize metal for your dollar right now, the premium math on older coins can make more sense than shiny modern rounds sitting in the case. Not because they look better, not because they're trending, because the spread between spot and premium feels more tolerable. The second premiums enter the conversation, this stops being about charts and becomes about stress. Premiums expand or compress based on urgency. They reflect what people are actually willing to pay when uncertainty rises. That's why the debate becomes animated. There's a clear split between two types of buyers. One group prefers simplicity, clean 1-ounce rounds, government-minted pieces, uniform stacks, easy counting, minimal thinking. The other group leans toward older coins, pieces that already functioned as money, coins divisible by nature. Silver you can break into smaller transactions without cutting anything. Then comes the arithmetic. Constitutional silver has its own system. Face value multipliers, assumptions about silver content, quick mental math. For newcomers, it feels confusing. For those who understand it, it feels empowering. The dealer openly admits it isn't for everyone. That statement carries weight. When something isn't universally appealing but still sells out, that means the informed segment is acting decisively. It suggests conviction rather than impulse. Mercury dimes become the focus, not because they're mystical, because they satisfy multiple psychological needs at once. They're small, recognizable, familiar, easy to count, easy to trade, less intimidating than larger bars. Many buyers don't imagine themselves liquidating a 100-ounce bar in a crisis. They imagine flexibility, optionality, smaller units that feel manageable. So when the shop mentions that dimes moved quickly, it isn't throwaway commentary. It's evidence of preference shifting. Quarters are thinning too. Other old silver is running lighter. Inventory reveals truth. It shows what buyers reach for first. There's also a powerful moment where talk turns into action. Instead of theorizing, a budget is placed on the counter, roughly $100. The question becomes simple. How much silver does this buy today? The answer ends up being a handful of mercury dimes. That detail changes the tone. It transforms silver from abstract investment into tangible purchase. It makes the process feel ordinary, almost routine. There's even humor layered into it, a light family angle, a reference to influence from older generations. But underneath that humor is normalization. Silver buying is framed as something practical people do when the world feels unstable, and instability is part of the backdrop here. Throughout the shop discussion, geopolitical tension keeps resurfacing. Specifically, friction between the United States and Iran, mentions of military assets repositioning, a carrier group heading toward the region, negotiations being discussed, but with skepticism. The tone implies that diplomacy may be happening, but preparation is happening too. Then comes the familiar phrase, bad news can be good news for metals. Let's examine that carefully. When headlines feel heavy, most people do not chase the asset with the highest projected return. They move toward what feels solid, toward what they believe retains value if confidence in other systems falters. That's why the conversation jumps so naturally from military movements to coin trays. In the buyer's mind, it's a continuous narrative. If uncertainty rises, hold something tangible. Gold enters the discussion not as a trade, but as insurance. A story surfaces about a woman selling jewelry, but choosing to hold on to certain gold pieces because of advice from a grandfather who lived through war. His lesson was simple. Gold mattered when stability collapsed. You can dismiss anecdotes, but they influence real behavior. Most individuals don't calculate from spreadsheets. They act from stories. When enough people act from similar stories at the same time, demand patterns shift. So now multiple forces are layering together. Retail demand for small silver strengthens. Geopolitical tension simmers. Prices pulled back from prior highs, altering psychology. That pullback is framed as a second chance, an opportunity for those who missed earlier rallies. That framing is persuasive because it addresses regret. It makes buying feel like correction rather than risk. But not every pullback is opportunity. Sometimes it's warning. The crucial variable is why price declined. If the drop stemmed from emotional selling or leveraged positions unwinding, then stabilization can lead to renewed strength. But if the decline reflects deeper weakening in demand or liquidity, then buying simply because something is cheaper becomes dangerous. Price alone does not define value. And inside that shop discussion, another revealing detail emerges. On days when silver ticks up modestly, sellers appear quickly. Green candles trigger relief. People who bought during volatility use small rallies to exit. That behavior tells a story. If every bounce attracts supply, sustained upward momentum becomes difficult. For a durable move higher, participants eventually need to stop treating rallies as escape routes. There was even mention of a day where a line formed before opening, buyers and sellers both present. Two-sided markets are normal. They can be healthy. They can also signal indecision. The shop described activity as steady and busy, but not euphoric like prior spikes. That suggests cooling, possibly consolidation. Anchoring psychology explains part of this. When investors recently saw much higher prices, current levels feel like discounts. Even if those current levels would have sounded extreme a year earlier, the brain compares recent highs, not long-term context. So yes, retail demand can reawaken simply because price feels more attractive relative to memory, but attraction is not confirmation. Right now, the most important signal isn't the chart, it's behavior, and behavior is shifting quietly. There's another layer unfolding beneath this retail behavior, and it shows up in how product is being positioned. In the middle of this discussion about constitutional silver and thinning inventory, a new 5-ounce maple leaf coin from a national mint gets introduced. It's described as a first-of-its-kind issue, offered exclusively through one dealer. That detail isn't random. When heavier formats and exclusive releases start getting spotlighted, it usually signals something about the demand climate. Either appetite is strong and supply is adapting to meet it, or demand is uneven and urgency needs reinforcement. Sometimes both conditions exist at once. Product strategy follows attention, and attention right now is fragmented. Everyone has a prediction, everyone has a chart, so the market creates events, special releases, limited availability, exclusive channels. It's not accidental. The shop conversation keeps moving between product hype, geopolitical tension, and real inventory movement because those elements feed each other. Fear draws attention. Attention drives buying. Buying tightens supply. Tight supply reinforces fear. The cycle becomes self-sustaining. Now shift to the metals debate itself. The question posed is simple but emotionally charged. Out of gold, silver, and platinum, which one leads this year? The immediate answer from one side is silver. The reasoning is movement. Silver swings harder. It responds faster. It's volatile. That volatility attracts those who want action. It also intimidates those who prefer steadiness. Silver can reward boldness and punish hesitation in the same stretch of time. It can create excitement and anxiety within the same month. That personality defines it. Then platinum enters the discussion as the sleeper candidate, the overlooked metal, the contrarian pick. There's logic there. Platinum doesn't dominate retail conversation. It doesn't carry gold's historical symbolism or silver's speculative culture. It sits quieter. But when industrial shifts align or supply tightens, platinum can move dramatically. There's an important observation from the shop. Platinum isn't sitting prominently in the display case. It's not stocked like silver or gold. That matters. Liquidity isn't equal across metals. Platinum often requires ordering. Spreads can be wider. Exit paths can be narrower. The ride can be less forgiving. Calling something a sleeper sounds exciting. But sleepers can stay dormant longer than expected. Sometimes investors gravitate toward the contrarian metal because it feels early, because it feels less crowded. But early and correct are not synonyms. Now step beyond retail preference and into structural context. Silver is not purely a fear asset. It's an industrial backbone metal. And one of the most underappreciated constraints in the United States today is power infrastructure. Grid capacity limits, transformer shortages, interconnection delays, permitting resistance, lead times stretching out. Data centers want expansion, manufacturing wants scaling, electrification trends are accelerating, but electricity delivery is the bottleneck. When capital shifts toward upgrading grid systems, demand for materials follows. Transformers, switchgear, wiring, conductive components. Silver's role in conductivity is not theoretical. It's embedded in efficiency systems and high-performance electrical applications. That doesn't mean price explodes tomorrow. It means there is an ongoing structural pull that didn't exist at this magnitude decades ago when silver was primarily discussed as money. Solar adds another dimension. Even with incremental improvements in panel efficiency, sheer installation volume continues rising. Utility-scale projects, residential adoption, grid integration. Industrial demand becomes steady rather than sensational. So when someone claims silver only reacts to war headlines, that's incomplete. Headlines may spark volatility, but the woodpile beneath the spark is industrial demand. Gold functions differently. Gold reflects confidence, institutional trust, currency stability. It acts as ballast when monetary credibility wavers. Recent publicly available reserve summaries show official buying has remained meaningful. The pace shifts, the tone shifts, but the baseline presence remains. That matters. A background bid from official institutions alters gold's response profile during stress events. It creates foundational demand that retail speculation alone cannot replicate. So when bold price targets for gold are mentioned and then extended towards silver, the temptation is to focus on the numbers. But numbers distract from drivers. The real driver is confidence, trust in currency, perception of systemic stability, and that loops back to geopolitics. Tension between the United States and Iran is framed as a possible accelerant. Military repositioning, carrier groups moving toward the region, negotiations mentioned but doubted. Evacuation language appears in the conversation, a sense that preparation may be underway. But here's where caution matters. Acknowledging geopolitical risk is rational. Designing your entire allocation strategy around a worst-case scenario is not. Markets respond to escalation in layered ways. Sometimes metals surge immediately. Sometimes liquidity needs trigger broad selling before stabilization. Sometimes the dollar strengthens first. Sometimes bond yields react before commodities. The first reaction is rarely the final narrative. Positioning into uncertainty requires sizing discipline. If someone buys metals purely in response to a headline, they risk chasing emotion rather than strategy. Headline spikes can fade. When they do, regret sets in quickly. The metal itself didn't fail. The timing framework did. The shop conversation does emphasize something healthier. Long-term ownership, decades, not weeks. Passing tangible assets to future generations. Teaching younger family members about physical stores of value. That approach changes the experience entirely. When metals are viewed as generational hedges rather than short-term trades, volatility feels less threatening. Pullbacks feel less dramatic. There's also mention of a Long Beach coin show running from the 18th through the 20th, table 723 located near a grading service. Buying and selling all weekend. Coin shows reveal sentiment in ways charts cannot. You see what empties first. You observe negotiation tone. You hear urgency in voices. You notice hesitation. Behavior becomes visible. Then the conversation leans into human stories, war experiences, economic collapse references, gold preserving life narratives, helicopter metaphors. Emotion resonates. It drives urgency. But metals do not require catastrophe to justify ownership. They serve as diversification against inflation, debt accumulation, policy shifts, and currency erosion. These risks unfold gradually, quietly, without dramatic sirens. Owning metals from principle rather than panic produces steadier decisions. Right now, silver sits at the intersection of multiple forces. Retail demand present but not frenzied. Green day selling still visible. Industrial backdrop supportive. Geopolitical tension simmering. Product marketing amplifying urgency. It's not a simple environment. And the next sustained move in either direction will depend less on forecasts and more on how participants respond when price tests their patience. Now step back and look at the full picture, because the most important takeaway from that entire shop discussion is not a specific price target. It's not a bold forecast. It's behavior. Small silver moving steadily, constitutional coins thinning, buyers trying to stretch modest budgets, sellers appearing quickly when price ticks green, debate simmering between silver's volatility and platinum's quieter profile, and all of it unfolding beneath a layer of geopolitical tension that makes tangible assets feel relevant again. That combination matters. Markets rarely pivot because someone predicted a number correctly. They pivot because behavior patterns shift in durable ways. If this evolves into a sustained move higher, you'll notice certain signals repeating. Dips will get absorbed quickly. Premiums will remain stubborn rather than collapsing. The rush of sellers on minor green days will gradually slow. Shop shelves will stay thin not because supply vanishes, but because turnover remains constant. That's how a base strengthens. A base is not dramatic. It forms through repetition. Price tests lower, buyers step in. Price tests higher, selling pressure weakens. Confidence builds slowly. But the opposite can also develop. If every bounce continues attracting aggressive selling. If premiums compress sharply. If inventory starts flooding back into shops while buyer traffic softens, then the narrative changes. That would suggest caution outweighing conviction. Behavior tells you which direction the weight is leaning. Anchoring psychology remains a powerful influence. When investors recently witnessed much higher prices, current levels feel like opportunity, even if those levels would have sounded elevated not long ago. Memory distorts perception. Comparing price to a recent peak is different from evaluating it against long-term fundamentals. A decline from a high doesn't automatically equal value. It simply equals lower. The reason behind the movement matters. Another factor worth monitoring is enthusiasm level. During previous spikes, the atmosphere was closer to frenzy. Lines formed early. Inventory disappeared rapidly. Emotions ran high. The current tone described feels active but controlled. Busy but not euphoric. Cooling periods can signal consolidation. They can also reflect fading urgency. The key variable is consistency. If buyers remain steady across dips, that supports stability. If buyers hesitate while sellers gain confidence, pressure builds downward. Green day selling remains one of the most revealing indicators. When small rallies trigger relief-driven exits, it shows that a segment of the market lacks long-term conviction. They are waiting for escape rather than expansion. For a durable move higher, that mentality eventually needs to shift. At some point, rallies must stop being viewed as exit ramps and start being viewed as confirmation. Now return to the macro layer. Industrial demand does not produce daily headlines, but it exerts continuous influence. Infrastructure modernization, grid reinforcement, electrification expansion, solar integration. These forces move gradually yet persistently. Silver's dual identity complicates its behavior. It is both a monetary hedge and an industrial input. That duality amplifies volatility because it reacts to multiple narratives simultaneously. Gold's narrative is more singular. It reflects trust, currency confidence, institutional stability. When those factors wobble, gold often receives steady accumulation. Official reserve data in recent years has shown that central banks remain active participants. That activity creates a structural demand layer beneath market noise. Platinum remains more niche, less visible in retail cases, less liquid in some regions, capable of sharp movement under the right industrial conditions, but also subject to wider spreads and thinner participation. Choosing between these metals depends on objective and tolerance. Volatility preference matters, liquidity comfort matters, time horizon matters, geopolitical tension, especially surrounding the United States and Iran, adds emotional fuel, military repositioning, carrier deployments, negotiation skepticism, evacuation language. These headlines amplify urgency, but urgency must be filtered through discipline. Markets often react in unexpected sequences during escalation. Metals may spike immediately, or liquidity demand may cause temporary broad selling. Currency strength may complicate initial responses. Bond yields may move before commodities stabilize. The first move is rarely the final move. Position sizing becomes critical. Owning metals as part of diversified exposure is different from concentrating risk on a single dramatic outcome. If allocation is measured, volatility becomes tolerable. If exposure is excessive, even minor reversals feel catastrophic. Emotional decisions magnify regret. The shop conversation emphasized generational thinking, holding for decades, passing tangible assets to children, teaching resilience. That long-term lens changes everything. Pullbacks become incremental entry points rather than existential threats. Short-term volatility becomes background noise rather than crisis. Coin shows, like the Long Beach event running from the 18th through the 20th at table 723 near a grading service, provide real-time insight into sentiment. Dealers observe which products disappear first, which items linger, how aggressively buyers negotiate, whether sellers appear anxious or confident. Charts cannot replicate human interaction. Human stories also shape behavior. War survival narratives, economic collapse references, gold as last resort protection imagery. These stories resonate because they simplify complex risk into tangible memory. But metals do not require collapse to matter. They provide diversification against inflation, erosion, debt expansion, policy instability, and currency uncertainty. These risks accumulate quietly. They do not always trend online. Accumulation driven by principle rather than panic tends to be steadier. So where does silver stand now? Retail demand is present. Small denominations are moving. Sellers remain active on modest strength. Industrial fundamentals provide structural support. Geopolitical tension remains unresolved but not explosive. The ingredients are present. Whether they combine into sustained momentum depends on repetition. If dips continue attracting confident buyers and green day selling gradually fades, the base strengthens. Stronger bases support faster moves when momentum finally builds. If hesitation grows instead, if inventory piles up, if premiums erode sharply and buyer enthusiasm cools, Consolidation may extend or deepen. No chart guarantees direction. No headline guarantees outcome. Process matters more than prediction. Watch behavior when price tests conviction. Observe whether buyers hesitate or step forward. Notice whether shelves refill quickly or remain thin. Pay attention to whether discussions focus on accumulation or escape. Those signals reveal trajectory long before bold forecasts do. And remember, this perspective is for education and analysis, not financial advice. Every situation differs. Risk tolerance differs. Objectives differ. The goal is awareness, not certainty. Behavior is already speaking. The real question is who is listening.